I'll do my little brief introduction. We on YouTube, TikTok, Instagram, Facebook, LinkedIn. I got Clubhouse on the side. I'll let them go ahead and listen in. You folks on TikTok, we're gonna get into if you see me looking all over the place, it's because I've got a bunch of different screens up. Folks, my name is Otis James. I'm a full-time real estate investor out of the San Francisco Bay Area. I've been exposed to real estate most of my entire life, clearly all of my adult life. I was 3 years old going to real estate meetings with my father. I'm a licensed real estate broker in a couple states, like I've mentioned before. I am a long-term hold investor. I spent the better part of 20 years in the multifamily commercial industry. I was overseeing $650 million in multifamily commercial assets. I'm licensed in insurance. We ran a mortgage brokerage for 13 years and funded just under $1 billion. I invest all over the country. I consult not just domestically, but abroad. On the non-real estate side, on the entrepreneurial side, I took $585 one day and created a company that went on to generate seven figures. I'm the founder of the Four Data Points Academy. Four Data Points Academy is a real estate investing training platform. It is the only program that has no end date. It's the only program where you pay once and we stay with you as long as it takes until you are a seasoned real estate investor. I personally mentor 350 or so people, give or take. We've had some new family members come in recently. Four Data Points Academy is founded off the foundation of these four questions. What does it cost? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? The reason why we call it Four Data Points Academy is because everything else is built on top of those four questions. Those are four questions that we ask every time we are considering a real estate investment. Doesn't matter whether it's a piece of land, doesn't matter whether it's a single family home or a 2,000 unit development. Every aspect of real estate, I have some experience in, whether it's buying and selling notes, whether it's multifamily commercial, whether it's flipping long-term holds and blah, 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 all the stuff. We don't teach one particular strategy. We teach them all and allow you to use which strategy works best for you at the time. It's my job to get you to understand when to use what strategy, why they work, why they don't, where they work, where they won't, so on and so forth. I've been doing this for a very long time. I have a background in training. I've trained people that manage developments valued in the hundreds of millions of dollars. Not only that, in multiple aspects of real estate investing, I've been awarded. I've been awarded on the sales side. I've been awarded on the financial side and a few other places. So we are going to get into multifamily commercial investing today. And I'm going to teach the underwriting basics. Now, my philosophy is a little different. If you offer mentorship and you have the Four Data Points Academy, why do you give all this information away for free? Because I don't believe the information alone is enough to take you to the promised land. It's how do you interpret the information and how do you apply it in the real world? And that's where experience and support comes in. So that's what I'm here to educate you guys so you don't get out there and get into something that you can't get out of. The reason why I'm passionate about that, another reason I'm passionate about that, I should say, is because most of the people in our program came from other programs. And our biggest complaint is that they didn't know about us first. So if you want to vet me, you can go to LinkedIn to look at my multifamily commercial industry experience. You can go check my real estate licenses in the state of California and Georgia. You can go on our Google reviews and see what people are saying about us and all of the things. Again, I don't believe it's just about the information. I see too many situations where folks going to charge you $10,000 for a bunch of stuff you could have Googled. I know that because it happened to many people in our real estate family before they got to our real estate family. We are the last stop in real estate education, the last stop. There is no more education behind us. You come into our organization, you shouldn't have to ever pay for real estate education again. I don't care what it is. If it's not something we don't teach, if it's not something we teach directly, and it's not something that I'm well versed in, I haven't found much that I'm not well versed in the real estate space. But if that ever happens, I will literally hire consultants to come in, create a lesson, and I will teach it to everybody in the program. There's a point to this. The goal is my vision includes a long-term vision where we don't have to leave our organization for anything. So folks in our real estate family, if they need lending, we can go ahead and do that. Well, we do that now. If they need management, we can go ahead and do that. If they need to source deals, we can go ahead and do that. If they need legal structure, we can go ahead and do that and get them set up for that. Anything they need in the real estate investing space, it's going to be us. The goal is to be able to go into some of these communities and change the economic landscape in some of these disenfranchised communities without them ever knowing that we were there. In order to do that, you need power and influence. So I have no problem foregoing income in the beginning. We know is you can't have somebody pay one time and then allocate time and resources to them in perpetuity, or you will go bankrupt. I supplement our program with our real estate investing, and we use automations to run efficiently, and we're constantly trying to be more efficient, create a better end user experience. And that's the gist of my existence. So now we're going to talk about multifamily commercial investing. Why? Because the road to wealth goes through multifamily. Do I know people that are wealthy that, aloha, Nicola? Do I know people that are wealthy that are managing a bunch of single family homes? Absolutely. Do I know, let me see, use promote to attract more viewers to your live? I don't know. I don't know. I don't know what that is. Thank you folks for sharing the live on TikTok. The reason we're able to help so many people is because more people know about us. The more people that know about us, the more that contributes to power and influence. What do you do with power and influence? If you have a good heart, you help people. And some of you guys have witnessed me help some people, real time. That being said, I love this stuff. I love this stuff. I've been exposed to this stuff my entire life, folks. My entire life. We came down to San Jose, California in 1971. My father brought us down, and well, technically, he didn't bring me down. I hadn't been born yet. I was born in 1976, but coming from a real estate family, I was exposed to all of the ups and downs of the real estate investing world. When 1981 interest rates went up to 20%, I had to watch my dad navigate through that. And I was only 5 at the time, but things got really, really bad. And I remember we had a really, really big house, and then we had a really, really small house. So in retrospect, I know what happened there. The dot-com burst of the late 90s, the 2008 real estate debacle, what we're going through now, and going through all those things and being impacted by those things. And, I'm somebody that lost everything and had to build it back up multiple times. So I understand how to survive in an environment where you get kicked in the teeth. Can you invest in multifamily with a VA loan? Yes and no. Not multifamily commercial, but yes, multifamily. And keep in mind, we're talking about multifamily commercial today. So, duplex, triplex, and fourplex, that is multifamily. That's multifamily residential. Okay. Now, I got a gift for you guys. You folks on Clubhouse, there's only a few of you guys on there, but if you guys are listening, that link at the top gives you the 4 data points guide. It allows you to download it. And that 4 data points guide teaches you how to assess a deal in 1 to 4 units. Now, you can still apply it to multifamily commercial, but it requires a bit more instruction. Remember, 4 data points. What does it cost? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? That is how you assess a deal. Now, it takes a little experience for you to take the answers to those questions and see if this property fits into your buy box based on those 4 questions. But I teach you in the guide. You folks on TikTok, if you text guide to that number above my head, I will give you my multifamily commercial underwriting lesson. This is a lesson that we teach in the 4 Data Points Academy, and I will make sure that I get that to you. I may set up a link later for you guys to download it, but if you text the word guide to that phone number above my head, 702-710-8030, then I will make sure I get it to you. Now, the goal is to make sure people aren't out there getting into something they can't get out of. And these guides, these lessons, a lot of these lessons I put together. Dang, somebody was quick. Whoever has a phone number ending in 8308, you're on it. That's somebody that takes action right there. The purpose of me doing these guides initially was I used to speak at these, bunch of different real estate conferences. I don't speak as much anymore because I got my little man every other month, and so it makes traveling a bit limited. But I would come across people that had bad experiences as real estate investors or as aspiring real estate investors, because the real estate education training world is pretty much trash. They either know that 6 months isn't enough time to turn you into a real estate investor, and they charge you $25,000 for that, or they don't know, which means they're incompetent and they're not effective. And I just got tired of hearing the horror stories. So I didn't plan on starting the 4 Data Points Academy. Again, it was birthed out of necessity, and because of my professionalism and the way I like things, I have I have a strong teaching background, and with respect to organizational structure and all those other things, it was just easy for me to create this online training school. But I hear so many bad stories, and people only highlight their highlights, right? In the real estate investing space. So they highlight all the wins. And let me pause here because I want you guys to understand what I'm about to say next. Just because something is possible doesn't mean it's likely. Was that a pause? That was a minor pause. Just because something is possible does not mean it's likely. So if I market to people and say, hey, look, your first multifamily commercial deal should be no less than $1 million. Yes, that is possible if you are seasoned enough and you know all of the things that need to be in alignment, and you have the credit standing and you have the relationships, and you can raise capital, and you can articulate how to pay for something out of your exit strategy with a potential seller. Yes, that it is possible. It is not likely. You're talking about a less than 1% chance. If you can do that on your first deal, you would have already done it, and you don't need any real estate investing training. Okay. Just because something is possible doesn't mean it's likely. So when you guys see all of the marketing out there about real estate coaching and real estate investing training, really pay attention and really ask questions, right? Ask the right questions. What level of support do I get? What if I have a problem at 2 in the morning and I need somebody to contact? How quickly can I get a response? What type of continued education do you have in place? What about when the economy changes and the rules change? Can I come back and get support? Those are all valid questions when you're paying that kind of money for real estate investing training. Now, I can speak on it because I know what's out there. I know I've seen behind the curtain where all the large organizations they've tried to recruit me, thinking that I don't know what they thought I was going to do, but they tried to recruit me. I've been asked to be on TV a couple times, and I've turned all that stuff down. I have no interest in being a part of any of that trash. All right. Let me say the true only reason I did that because I'm a general contractor. All right. A general contractor, you got an advantage, right? If you're a general contractor, you got an advantage. Um, yeah, no, you definitely got an advantage. You can save on rehab costs, and rehabs are a significant part of investing when you're starting. I'm a value add investor. My goal is every single time I look at an investment, there's a few things that I want to accomplish. The first thing I want to accomplish is getting all of my money back out of the deal. The second thing that I want to accomplish is being able to keep the deal cash flowing. We can't talk about generational wealth if we keep selling everything. So if we sell something, that has to be a means to an end. Okay. It has to be a means to an end. If I'm selling something, it's because I'm putting cash into another investment, another cash flowing investment, right? A bigger one. So it has to be a means to an end. All right. Now I'm going to scan for, can you invest with, okay, I already answered that question. So I will, continue to, I got my boy Anthony Glenn right there. What's up, big dog? You always welcome to come up. You know what I'm saying? Brother from another, if you got time. So I'll continue to get to the questions. I don't mind stopping and answering these questions because, some of you have limited time, and I want to respect your time. And I'll continue to look at the questions as I'm talking because some of you may have to go. I appreciate you guys for sharing the room. Again, the more people that know about us, the more opportunities that we can create for other people. So, I'm too old to be asking for shares and likes and all that, but I see how it benefits some of the people that wouldn't have an opportunity had I not created one for them. And the more people that know about me, it makes that possible. So thank you very much to you 9 people on TikTok that shared the room. All right, let's talk about multifamily commercial investing. All right. Now I'm going to read straight off this lesson. Okay. I'll deviate. I'll kind of come on and come off of it, as needed. But, I like to teach. Okay. I like to teach. Our time is valuable. And I want to honor your time by teaching and not doing what my grandparents used to call shucking and jiving. All right. All right. Why am I qualified to teach this? Well, I just went over my background, but my background on the operations side of multifamily commercial allows me special insight past just the investing, right? It's not just enough to invest in multifamily commercial. you have to have an understanding of what it takes to make it profitable. So when my students come in, I teach them the basic underwriting, but I already know that I'm going to have to get directly involved when it's time to take down a transaction, because I don't feel comfortable sending somebody out there to do something for the first time. There's just too many things that could go wrong, right? So not only do I help them with the acquisition and underwriting to determine whether it's going to be a good deal in the first place, I also help them set up the operational stuff, right? Their screening process, their renewal process, their request process, their deposit accounting process, their eviction process. I give them the vision and understand how to have a balance between, raising rents and saving on vacancy loss. All of these things, I have to get directly involved with them to do. So our focus today is going to be on underwriting, determining whether or not a multifamily commercial deal is worth our time in the first place. All right. So where are we going to start? Understand the property and the market. Now, this is a little bit different from multifamily. This is a little bit different from residential for a couple of reasons. Have you helped folks invest in triple net leases? Everything, Adrian, everything that is involved in multifamily commercial, I've done, and we do every single thing. So I know it's some of you guys may be curious about, do you do this and do you do that? We do all of it. I'm a seasoned investor. I don't believe you can be a seasoned investor if you're not capable of doing all of those things. I also have a responsibility to make sure none of my real estate family is left out there trying to figure out what to do next. So I literally spend time searching for things that I don't know. So the likelihood of me not doing a particular thing with respect to some of the things that I'm talking about is very, very slim. Amen. All right. But I mean, good question. Keep the questions coming. But yeah, we do help folks invest in triple net leases, not invest in triple net leases, but utilize triple net leases with their investments. All right. Now, multifamily commercial is a little bit different from residential for a lot of obvious reasons, but one in particular, outside of how the different asset classes are valued, is when I'm looking at a 1 to 4 unit property, I look at the address and do my due diligence based on the address. I ask those 4 questions based on the address itself because I'm using comparable sales close to that property to help determine its value. When it comes to multifamily commercial, I go a little wider and look at the market because I have more doors to fill. So we can go into some of those things that I look at when we get into multifamily commercial. But understanding the property in the market, what type of property is it? Is it garden style? Is it mid-rise? Is it a walk-up? Because when you start thinking about maintenance, those things matter, right? How many units is it? What's the unit mix? Now, I have a template that I fill out when I'm looking at a multifamily commercial deal, and I literally just put all the different unit types in there and, all of the information on there so I can have it right in front of me. But it's important to understand how many different unit types there are because multifamily commercial is valued based on the income that it generates, which means I have to do a market survey, a rental survey in that market to see what my potential rent is going to be. And if I have multiple unit types, that means I have to do a separate survey for each unit type. For example, what's the potential on my 1 bedrooms? What's the potential on my 2 bedrooms and 3 bedrooms or studios and so on and so forth. All right. What's the condition like? 4 data points. Remember, always keep that at the forefront of your mind. What is the condition like? What does it cost? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? Let's go back to number 2. What does it cost to fix up? I don't care how much rent it's getting. I'm concerned about what is it going to cost me? How much money am I going to have to put into that project to get to that type of rent? So that is very, very important to me. Is the neighborhood growing, stable, or declining? Now, I can have 2 assets in different markets. Let's take a 10-unit building in one city and then across the country, another 10-unit building that have the same financials. And if I have to choose and the numbers are too close together, I'm going to look at the market and see if it's improving or it's declining. All right. What are the comparable rents in the area? I already said that. I look at those because multifamily commercial is valued based on the income that it generates. All right. See, Clubhouse, this is interesting because you have, oh, actually, no, that's my fault. Never mind. I was about to vent for a second. All right. So these are the things that when we're understanding the property and the market, these are the things that we're looking at. Quick reset. If you guys want this underwriting guide for multifamily commercial, go ahead and text the word guide to that number above my head, and I will go ahead and get you a link to it. All right. Are there any major employers nearby? Now, we're still talking about understanding the market. Why do we care? Let me talk about that for a second, because this is where a lot of people get got. Typically, when you hear news like, hey, Tesla's coming to Austin, or Google is coming to, and you folks on TikTok, again, I can see your questions. I'll go ahead and interrupt myself to go ahead and ask them. Again, I want to honor your time, so I, I I don't mind interrupting myself to answer your questions. Again, you folks on Clubhouse, you guys are up too, but same with you guys on YouTube, Facebook, and Instagram. If I see your questions, I'll go ahead and answer them. So, are there any major employers nearby? This is where people get taken advantage of. Maybe let me not say taken advantage of. That's kind of harsh. But I get people calling me all the time. They say, "Hey, this company is supposed to be coming to St. Louis, or this company is coming to Memphis." So a lot of people get excited about that, but they don't actually do the due diligence to find out what the impact that company is going to have on the community. And I'll give you an example. Back in the day, Amazon was going to, there was a rumor that they were going to add a fulfillment center to South San Jose. Okay. And so people were calling saying, hey, maybe I can get a 4 unit or a 2 unit or some of these things. Right now, I always have the same response. Okay, well, let's look at an Amazon fulfillment center. What is the average income from someone that works in an Amazon fulfillment center? At the time, it was $17 to $22 an hour. What is the average home price in this area? It was $1 million, right? San Jose it was over $1 million. Like a 4 bedroom, you're probably looking at a decent one is about $1.4 million. Okay, no one over there at the Amazon fulfillment center is going to be able to afford a home. What is the average rent in that area for a nice apartment? Well, for a 1 bedroom, it's about $3,000. Okay. No one from the Amazon fulfillment center is going to be able to afford $3,000 in rent unless you have roommates. So if you are looking to acquire real estate or build something in that particular market, and you're doing it based on a rumor that a company is coming there, then that's probably not going to serve you very well. Right now, if their corporate headquarters was coming there, maybe I get it. I can make an argument for that. But what major employers are nearby is not enough to make me go ahead and pull the trigger. Right? What's the local vacancy rate? Well, I look at the local vacancy rate because I got doors I got to fill. Right? Now, these things, what type of property is it? How many units? What's the condition? What's the neighborhood like? What's the comparable rents in the area? Are there major employers nearby? And again, I want to stress that make sure you do your due diligence on the employer. What's the local vacancy rate? That gives you important context, right? A 10-unit building in a growing city is very different from a 10-unit building in a declining town, even if the numbers look similar. Okay. So keep that in mind. Now, this is the meat of underwriting that I'm about to get into, right? That's right, King. This is an investor mindset. Amen. Now, again, my background in multifamily commercial, I was on the operation side. I was overseeing $650 million. At the time, that was regular market unit. That was Section 8 unit. That was rent controlled. So all of the different types of management I've been directly involved in and awarded in, mind you. You like I throw that in there? And awarded in. All right. No one's clapping. Just me. Okay, that's fine. You guys are probably all clapping behind the camera. All right. So gather the property's financials, because multifamily commercial is valued based on the income that it generates. More specifically, the net operating income. There's 4 things that they usually have readily available when they are advertising these asset classes. Okay. Now, if I go on some of the websites where you can buy apartment buildings, most of the time they'll have a rent roll. Sometimes they'll have a trailing 12. Occasionally they'll have an operating expense report. Occasionally they'll have a CapEx report, and I'll explain what those are. But then I'm going to list all of the documents involved in the due diligence. Now, if you guys want this guide, I know some of you guys are good note takers. You'll notice I talk fast because I got a lot I got to get out. And so just listen and I'll get the guide to you. All this information is off the guide from the 4 Data Points Academy. Right now, I also want to say, please don't take this guide and get out there and try to do this on your own. There's too many variables in the multifamily commercial space that can land you into bankruptcy. all right, or at least whatever your entity into bankruptcy. All right. So I'm more than happy to give you the guide. It is not enough to turn you into a seasoned real estate investor. It's for information purposes only. But for those that want to further their education and maybe are not in a position to get mentorship, at least with this, I know you're not going to get into any trouble. It's going to force you to look at things that will raise a red flag even for a new investor. Amen. All right. What's the rent roll? It's a unit by unit list of tenants, lease terms, and rent amounts. That's it. It's a rent roll. Okay. What is a trailing 12? It's a 12-month breakdown of income and expenses. So why is it called a trailing 12? Because it's of the previous 12 months, not of the previous calendar year. Okay. So that is document number 2 when you're evaluating multifamily commercial. Operating expense report. All right. Well, what is that? It's a detailed list of ongoing expenses. CapEx, past or upcoming big ticket improvements. Now, multifamily commercial is valued this way. You take the net operating income divided by the cap rate. What is the cap rate? The cap rate is the relationship between a building's net operating income and its market value, or what it's sold for, which we interpret as the market value. For example, if a building, if I'm looking at a property in, San Jose, and a building in that area about a month ago sold for $300,000, and it had a net operating income of $30,000. 30,000 divided by 300,000, net operating income divided by market value equals cap rate. That's a 10% cap rate. Okay. Now you take all the transactions in an area and you come up with the average cap rate for an area. And then you apply that cap rate to your subject property when figuring out what your subject property is going to be worth. So you find out what the net operating income is on your subject property, which is NOI, divided by the neighborhood cap rate, and then you come up with a number. That number is the value of the property. Amen? All right. Now, the difference between a capital expenditure, we digging deep now. The difference between a capital expenditure and regular repairs and maintenance is they impact the value differently. Repairs and maintenance affect a building's net operating income. Capital expenditures affect the building's original cost basis. What's the cost basis? The cost basis is the number that they use to calculate what your capital gains tax is going to be if you sell the property. I'm not going to get too deep, but I'm going to give you an example. If I buy a building for $400,000, or any piece of real estate for that matter, for $400,000, and then I sell it for $500,000, I'm going to pay capital gains tax on that $100,000 gain, minus, cost to sell and all that stuff. Okay. Now, if I buy that same building for $400,000 and then sell it for $500,000, but this time I added a capital expense, right? Maybe I replaced a roof for $30,000. Well, that is now a step up in cost basis. So instead of them calculating my capital gains from 400 to 500,000, now they calculate it from 430, which is the cost of that improvement, to 500,000. So instead of being taxed on the 400, I'm taxed on 70,000. Right? So it's a step up in cost basis. Now, that's common knowledge, folks. If you have tax questions or legal questions, please consult a qualified professional. I'm not one of those, so I want to make sure I make that disclaimer. What vacancy rate do you look for in a city before you invest? I don't necessarily look at the vacancy rate in the entire city. I'll typically get as granular as a zip code because the environment in a city can change so drastically. You can have some areas with a high demand, some areas with low demand. So I kind of look at both, right? I look at both. And it also depends on how many doors I have to fill. I get a lot more granular if I've got to fill over 20 doors, whereas if I got to fill 5 doors, it's a little bit different, okay? Because the demand's going to be higher. Now, here's a red flag. And thank you guys again. I see you guys sharing the room on TikTok. I really appreciate it. I'm telling you, it doesn't go unnoticed. So I'm giving you guys this guide. This guide is years of experience into this guide, Trust me, this is something you would have to pay for elsewhere. So you mainly do commercial units. I do everything. And for investors that I train them to do everything because there may be one sector of investing that is non-performing. They still got to feed their families. So maybe they have to go over to another sector to be able to do some deals, right? Maybe, I know people that don't flip houses, but when the multifamily commercial takes a hit, then they got to go flip some houses to generate some cash. Or maybe they buy and sell debt, or maybe they lend on properties, or maybe they put deals together that they're not directly involved in and take a fee for that. So I that's all of the how many properties do you have? Oh, well, you'll never know, huh? You'll never know. Me, Otis James, how many properties do I have? If you were the federal government and you asked me how many properties I had, the answer would be zero. Right? The answer would be zero. Otis James doesn't own anything, all right, on paper. All right. I flipped and switched to the BRRRR because capital gains tax. That's great. The BRRRR method is just a tool. Sometimes it works, sometimes it doesn't. Uh, you know, the BRRRR method doesn't work in high cost areas, and it doesn't work in instances where the money is expensive because the rental income on your exit is not enough to service the debt. Landon says, why? Why don't I disclose everything I own? Because I pay a lot of money to accomplish three things. One is liability protection. The other is tax favor. The other is anonymity. So if I pay to be structured on the anonymity side, me going on social media and telling everybody everything I own, you don't think they'll bring that up in court if I get sued or something like that? So yeah, but I'll tell you this, my investment company is James Street Capital. And if you look hard enough, I still have some assets in that name that haven't been transferred out yet. So if you need, a few million just to satisfy your appetite, you could do a search on James Street Capital. It works sometimes. Yes, it does work sometimes. It's my job to teach people when it works and when it doesn't. And when it doesn't work, it doesn't mean that that's a bad investment strategy or that's a bad investment, I should say. It just means it's a different type of investing. And if you guys want me to get into the dynamics of the BRRRR method, I can do that a little later. But yeah, the BRRRR method it's just a tool like a bunch of other ones, right? There's not one tool that works all the time. So if you're going to be a seasoned real estate investor, you better know all of them. All right. And the BRRRR method could be used with multifamily commercial also. I actually like it. Landon said, I'm not the Fed. I don't know. Well, hey, all right. Well, okay, cool. I'm glad. So in multifamily commercial, the BRRRR method can be used also. But again, it's up to you to look at a deal itself and determine which strategy you should use. If the BRRRR method is going to work, then guess what? The 4 data points will tell you. What does it cost? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? These 4 data points apply to multifamily, commercial, and residential. If you answer those 4 questions, you'll see if the rental income is enough to service the debt on your exit. If it is, you do the BRRRR method. If it's not, there's still money there. You could just make it a flip. I'm from the San Francisco Bay Area. You could walk in my neighborhood with $1 million. You won't even be able to find a fixer-upper. Well, you might be able to find a fixer-upper for $1 million. So we have to do things a little different. We also have to be able to invest all over the country, which is why I train people not just to invest all over the country, but I also train them to do it from a distance while they're still working a full-time job. Real estate is tough right now. Real estate is not all the same everywhere. So real estate is a generalization, and I understand what it means, but it's typically when you're approaching it as a consumer, it depends on how you're approaching it. I can approach it as a consumer. I can approach it as a real estate investor. I can approach it as a real estate broker. I can approach it as someone that puts investment groups together. Each one of those is going to require a different set of lenses that we see real estate through. So the better versed you are, the more opportunities you see. If a market is bad, I go to another market. If a strategy isn't working, I go to a market where a different strategy is going to be more fruitful. Amen. You're right. I turn deals down now if they don't fit my BRRRR plan, probably leaving money on the table. I mean, I'm sure we're all leaving money on the table somewhere, but all money ain't good money. So, if you have a buy box and the BRRRR method is your buy box, just stick to it. Don't get caught up in, all the other stuff. All right. So let's get back into it. So we're talking about multifamily commercial. And again, you folks on TikTok, if you text the word guide to the number above my head, I'll give you the lesson guide. So you don't have to take notes. You can just you can just read it. All right. Again, I just want to reiterate, don't get out there and try to do this yourself if you're not trained to do it. A lot of this is nuanced. right? So you have to look at everything and not just what's in front of you when it comes to real estate investing. And that's where experience comes in. Now, we talked about 4 documents that we typically need when we're reviewing a property's financials. Why are reviewing the financials important for multifamily commercial? Because those asset classes are valued based on their financials. So we have 4 other documents to request during the due diligence. So while the rent roll, trailing 12, and operating expense breakdown are important, there's additional documents that I request during the actual due diligence period. Now, the rent roll, the trailing 12, the operating expense report, and the capital expenditures report, they typically have that at the ready that they give to prospective buyers. All right. But once I review those and decide I want to move forward, there's an inspection period. Every time you write a contract or an offer, which is a contract, on a piece of real estate, it requires you to put what the inspection period is. Any contract worth its weight in salt. If you go on eForms or Rocket Lawyer or any of the basic contracts, all right, Tavis, I got you. Any of the basic contracts, it's going to have this in there. And because I have background in the multifamily commercial industry, my due diligence is a little more involved than the typical investor. And what happened was in the multifamily commercial industry, if the organization was going to buy a building or an asset, these were typically A class, B plus, A class assets. So they are newer product, and they were valued. They can be valued anywhere from 200 to $400 million. So we didn't just request financials. We sent a team of 30 people out there for a week to go ahead and do the diligence on these properties. So some of these documents that I am sharing with you guys are going to be a little overkill, but keep in mind, and this is important, you need to know what to do if they don't have any documents. Okay. So when I'm teaching people and I'm training them to be able to do this from scratch. Okay. Know what to do when you don't know what to do. That's what I tell my students. Know what to do when you don't know what to do. All right. So other documents, I have a list here. Okay. So hang tight. All right. And the question, yeah, and the questions are, these are good questions, you guys. So thank you for Landon. Those are some good questions. Interest rates are killing housing right now. I think, well, for consumers, they are impacting housing. I think there's things that are impacting housing even more than interest rates. Interest rates right now are normal. So we've just been spoiled, right? The things that are impacting housing, especially on the apartment level, is one, the permitting process is too slow. They would have nickel and dime you for everything, right? For everything, and insurance premiums. What do you think happens to the value of your building when your insurance premiums go up? Well, that impacts your net operating income. When the net operating income is reduced and maintenance hasn't gone down, then the value of the building goes down. What mindset shift do you have when you went from small to big? There wasn't really a shift. I think the biggest for me, it was I was already in the multifamily commercial industry, so it didn't matter what the outcome was. I didn't have any risk. That was my corporate job. Now I was investing and training people and doing all those things. I was a licensed real estate broker. That was my corporate job. So there's no pressure. So if everything failed, I'm still getting a check every 2 weeks. And, they paid me decent, right? It was over $150,000 a year. And the reason I left was because it was at one point, that was only like 12% of my income. So I love the multifamily commercial industry. I go back in, because I'm able to work from home and I can still do everything. So it wasn't really the mindset shift this is just, King, I'm glad you asked that question. This is you can teach people the mechanics of real estate investing. What you can't teach people is how to get over the fear of taking action. Okay. That's what you cannot teach people. And the hardest thing is to go from a poor person's mindset to a wealth mindset. That is no reflection of the person itself. That's because we've been conditioned to think a certain way. And things are so expensive here in this country that we got to survive, right? So it's hard to think big when you're so focused on just surviving. All right. So when it comes time for people to get out of their comfort zone, I don't force them to do that. The people in my real estate family, it's my job to expand their comfort zone continuously so they never have to get out of it. And then, at some point they're like, oh man, they look back and see how much they've accomplished. And then they don't recall the shift, right? We've got people that started with zero knowledge. I got some people with 20 doors, 30 doors, getting vertically integrated with other companies that they're buying. So, I think if you're listening to the sound of my voice right now and you've been listening for more than 30 seconds, you're already doing something right because you understand the value of information. And if you understand the value of time, you understand you're not spending it with me right now. You're investing it because you're getting something out of it. Landon says, at least you're not a wholesaler. Well, I wouldn't say, I could wholesale if I needed to. The thing about being a wholesaler is you're already doing the hardest part. And because you don't have the real estate strategies to take the deal down yourself, you assume that because you don't have the capital, you got to pass it on to somebody else. But I've been on here for years teaching, well, not TikTok, this is a new page, but I've been on these platforms teaching people how to buy real estate out of their exit so they don't need a down payment. But you could go on my Instagram right now and learn how to buy a piece of real estate and pay out of your exit strategy. But the problem is nobody is really gravitating towards that because, I'm not walking across the screen with my ass out and I don't have breasts. But, if I ever do get those things, then I'm sure I'll get a lot more views on some of these, on some of these posts. I did one post teaching people in the post how to structure a deal creatively. I posted that, went to the kitchen to get some food. I came back. I was like, I should probably get ready because it's going to be viral by the time I get back. I better call my family and let them all know that this is it. I came back. It was like 3 views. And one of them was my mom, I think. She's still so proud. That's just the world we live in, folks. There's a reason why the 1% is the 1%, and the 99 is the 99%. All right. So, that's something we had to get over. Those are growing pains, right? Because my little feelings was hurt. I'll say if you're giving from your overflow, you must be extremely successful. Oh man. I mean, I don't think I'm I don't think I'm extremely successful. I'm looking at where I'm trying to go, and where I'm trying to go doesn't have a number attached to it. I look at money a little different. Money doesn't bring me fulfillment. Freedom. I'm fighting for my freedom, right? Once you get to a certain level, you can look outside, you see what this country really is, the more informed you are. So there's a lot of pressure on me not to be able to have a situation where I can take all my family and extended family and have places for them in other countries, so they can relieve some of the stress. So it's extremely successful. I mean, I don't know, man. I think I think a dad that works his ass off regardless of what he's doing and comes home every day and spends time with his kids and the kids look up to him. I think that's the definition of success. So, I mean, we can get caught up in numbers, but I mean, I'm not extremely successful by my. I don't gauge success based on a number. I know there's a number that I have to make. Like I have to make $1 million just to be able to operate. I have to do some of these things. And there's been months where I've made $200,000-300,000 in that month and only got to keep 12, right? Whereas there may have been somebody in that month that only made $13,000 and got to keep it all. So who's more successful? So the goal is not, I don't chase those things anymore. I chase a quality of life, but I also understand that that requires finance. Things that bring me fulfillment is doing this, creating opportunities for people that wouldn't necessarily have them. I got a single mom that was living in a hotel with 4 kids. Now she's got a job and a place to live. And, I've mentored her early on. That brings me fulfillment. And most of you guys that have been following me on the other platforms, people think I'm way richer than I am because of how much money I give away. I'm just not attached to it like that. When it's easy to make, it may not always be easy to make when I want to make it, right? But, the goal is just not to have to worry about money. And in order to not have to worry about money, you need to make money to put yourself in a position where you don't have to worry about it. By that, I mean, you're giving great info. I appreciate that, King. I appreciate that. Honor that by, doing something with it. But these lessons also, it makes it really hard for somebody to scam you all when you got these lessons in front of you. All right. So getting back into it, let me see. Best advice: pay off your home, stay away from high interest credit cards or loans. Yeah, I wouldn't pay off my home. Um, that's a good one. I don't. If it was up to me, I wouldn't own a personal residence. I would just own investment property, and then I would go rent a house. I mean, I could pay off my home tomorrow. I still don't own it. My property taxes are, $1,300 a month just in property taxes. And I got to pay those forever. Right. I got to pay insurance on it forever. So is it really my home? So there's good debt and bad debt. Pay off, all of the depreciating assets, pay off credit cards, high interest credit cards and all that. But if I have homes with no debt on it, that's fine. But the road to wealth, you got to use debt. You get there a lot faster. And it's not an opinion, it's just math. If you can leverage debt the right way, the road to wealth is a lot straighter, right? Now I understand while, there are some people that are afraid of debt. And I understand why they are, because there was a time people that looked like me were taken advantage of with high interest loans and there was just predatory lending and we were victims of that. So I get that, especially the baby boomers and those those folks back then. But now things are different. So I think understanding how debt works and how to manage it will get you to wealth a lot quicker. And it's just math. It's not it's not an opinion. It's just math. And if you don't believe me, write your 5-year plan. Write one based on paying all this stuff off, and write one based on leveraging debt, and let the math tell you what's going to get you to where you want quicker. All right. Additional documents. So we were talking about what documents to request during the due diligence for a multifamily commercial deal. All right. And again, if you guys on TikTok could share the room, I really appreciate that. If we get to, we're at, what are we at? 9 shares. If we get to 50 shares today, I got another, I'm going to give you guys something else, right? Something else of value, right? I'm going to give you guys something else of value. You guys are on TikTok. All right. Now, property management agreements. We're talking about additional documents. So this is the assumption that we ran the 4 data points, and the 4 data points again are: what is the cost? What is the cost to fix up? What's it going to be worth when I'm done? How much income can it generate? Right? 10 shares. Y'all moving slow, but it's all good. How much income can it generate? Based on the answers to those questions, we decided that this apartment building we may be considering is worth putting an offer in. So we put the offer in, offer gets accepted, the due diligence time frame begins. Now, we've already asked for the 4 basic documents. Those were the rent roll, which is a unit by unit list of tenants, lease terms, and rent amounts. We asked for a trailing 12, which is a 12-month breakdown of income and expenses. Can I get your opinion on taking a loan from a stack for, oh yeah, okay. All right, I'm gonna touch that in a second. We asked for the trailing 12. That's a list of income and expenses for the previous 12 months, not the previous calendar year. We asked for an operating expense report, which is a detailed list of ongoing expenses. We asked for a CapEx report, which is past or upcoming big ticket improvements. They usually have that at the ready if it's listed by an agent, right? So there's additional documents that we are going to utilize also. We're at 12 shares. If we get to 50, I'm gonna give y'all something. So these are the additional documents that I will request during the due diligence period. Property management agreement. Now, I have trained property management companies, and the property management companies that I had, managing some of my own assets, I had to train them, right? Because they're mom and pops and they aren't used to managing property at a particular level. But I look at what agreements are in place, and if those agreements are satisfactory to me, then I may go ahead and keep them on. I look at service contracts. Now, again, you guys that text that number above my head, you text the word guide. I'm going to give you this. I'm just reading from it. This is our lesson on the multifamily commercial space, and these additional documents are all listed on this lesson. Service contracts: trash, landscaping, pest control, HVAC, laundry machines, etc. Looking at all those. Utility bills. I'm looking at the last 12 months: water, sewer, gas, and electric, if it's owner paid. If they're not owner paid, meaning if the building is sub-metered, meaning all of the tenants pay their own rent, pay their own rent. Yeah, they pay their own rent, their own utilities. Then I don't have to look at that because that's not going to impact me. Real estate tax bill for the most recent year. Now, I take that with a grain of salt. I just want to confirm what the tax rate is in a particular area. I do understand that my tax bill is going to be different because the building gets reassessed when it changes ownership. It can also be reassessed if you've improved it past a certain level. All right. Print. Can I get your opinion on taking a loan from a stacked 401k to buy my first rental property? Reach out to me, because I actually had some people. I have a lot of people in that same situation. Reach out to me and I'll show you how to be able to do that. Set up a call with me, because if you've got that, then you got a lot of opportunity. All right. Insurance page, their declaration page. The reason why I look at their declarations page is because I may continue on with that insurance carrier because they're already familiar with the building and it's just going to be a change of ownership. All right. Capital expenditures log, basically it's repairs and upgrades over the past 5 years. If they have that, great. If they don't, well, it is what it is. Keep in mind, folks, most mom and pops are not going to have all these documents. So you do have to learn how to be able to uh, figure all of this out without any of these documents. I mean, you have to be able to start from scratch and go from there. Even when they do have some of these documents, that doesn't necessarily mean I believe them. I know shady investors out there, they can fabricate any document that you want. They can fabricate it, they can make it up. All right. Let me see. Maintenance work orders. Typically, maintenance work orders, what I'll do is I'll look to see what property management software that they use. And then I will request based on what that software is. For example, a lot of the software, they keep service request records and they also keep correspondence. One of the things I did not add on this list is a list of correspondence. Most of them don't have that. I mean, most of the people that are selling these properties don't have that. But it's important for this reason. It's important to understand the type of service requests and the correspondence between the management company and the tenants, because what happens is some owners will try to put lipstick on a pig or do band-aid fixes so they don't have to cover a major expense. For example, this is the most common. If I'm looking at the service requests and I see a bunch of, plumbing service requests for snake and drains, $150 service call. Yeah, that impacts their net operating income, but that's not enough for really, that's not life-changing, right? It's not going to hurt me. But if I see enough of them, then I can see that is the symptom of a much larger problem. And there's probably an impending mainline replacement that needs to be done. But if they believe that that replacement is going to impact their net operating income significantly, they'll probably just keep treating the symptoms. Now, a lot of mom and pop owners don't understand the difference between capital expenditures and maintenance. Capital expenditures don't impact your net operating income. So when I'm teaching my students, I say, look, every time you are going to fix something and you have to choose between fixing or replacing, let's have a conversation, because replacing it, depending on what it is, will not impact your net operating income. Repairing it may. It also matters in how you book it. So if you get audited and they look at all of these expenses, there's a big difference between repair and replace. Okay? Repair and replace. Landon says, leave your 401 alone. I'm assuming he says, leave your 401k alone. I don't think that's the best advice. I think you should let the math determine what you do with your 401k. I always look at the math. I'm not biased, and I'm not married to one particular idea. Whatever the math says is better. If you're getting a year-over-year return of 8% on a 401k, I can turn that 401k into $1 million in 3 years. Why would you, I don't, yeah. You can borrow against it, right? Borrow against your 401k. I think you should weigh all your options. I don't think you should just cash out your 401k just to get some capital. Cash out your 401k if you've got a better income opportunity. I wouldn't just do it to do it. So again, I always go to the math. All right. Math don't lie. All right. Maintenance work orders, occupancy reports for the last 12 months, bank statements to verify income if financials are unclear, environmental reports. Phase 1 or phase 2 if previously conducted, appraisal. I'll typically consult an appraiser, but I won't do an actual appraisal because I'm going to have to do one anyway through the lender. So I'm not going to pay twice, right? But I may do have an appraiser do what we call a desk review. Survey, all right? Just checking property lines, the boundary survey. Title report, preliminary title commitment. You typically get that when you open up escrow. They'll typically have that for you. Leases, copies of current leases, especially if not listed on the rent roll. Why do we look at leases? I look at leases for a number of reasons. And it's not just to confirm how much rent they're paying. I want to look at, of course, how much rent they're paying, but I want to look at the rules that they're obligated to. Well, why is that important? Well, if the property is master metered meaning that there's one bill for the building and then management bills back the tenants for their portion of it. Then there needs to be language in the lease agreements that talks about occupancy standards. Well, why is that important? And why, if it's sub-metered, do I not care about occupancy standards? Well, because of this. I have to pay the big bill and bill back everybody their portion, which is already outlined in their lease agreements. So if I'm billing back every unit $30 a month for water, and they've got 5 people living there in a 1-bedroom, and they're taking 5 showers a day, if they're like me, taking, 10 showers a day, then I'm going to have a significant loss when I look at the difference between the big bill that I have to pay and what I recoup from the tenants. So I'm looking at the leases to make sure that there's language to protect me from that. All right. Move-in condition reports. I want to see what the condition of the property was when they moved in. Now, we're going to get into deposit accounting. And when we start talking about move-in conditions, and this is one of the things that a lot of educational companies don't train because they don't have the operational experience and haven't had to deal with this on a large scale. All right. Eviction history, notices issued, that's all in the file. Deferred maintenance list, good luck getting that. They're not going to share that with you. All right. City violations, code enforcement notices, all typically go to the building department. Building department works in tandem with code enforcement 9 times out of 10, depending on what city you're in. And I'll go ahead and see what violations there are. Permits and inspection history, I'll do that while I'm there also. Or I'll send somebody to do it. All right. Most of the time, well, I won't get into that. All right. So those are all of the items that I request during the due diligence period. All right. So now let me go back to some of these questions. Let me see. Y'all quiet over there on the Clubhouse. Oh, there's only a few of y'all over there. All right. Let's see. Let me scroll up. Can I get, okay. Yeah. Don't touch any investment vehicles until you have a plan and you have a roadmap to where you can look at the potential income versus what it costs you to leverage that investment vehicle. I get really weary when people just start cashing out their 401ks and all that stuff to go invest in real estate. I usually encourage them to pause, see if they can borrow against it, and then use the income from that real estate or income producing property to pay it back, right? So we can avoid the tax penalties and all those other things. All right. I think we're good on questions. All right. Now, calculating net operating income. It's just a formula, folks. Are sellers really as thorough as you and have all this info available for you? Sellers are not this thorough. No, they are not. The only time that they're going to be this thorough is if they're much larger, right? 100 units and up, managed by a professional property management company and not a mom and pop. But no, you're rarely going to find sellers that are this thorough. 9 times out of 10, you may have the first 4 documents, maybe a few of the other ones we went over. I've never encountered a mom and pop. And by mom and pop, I mean, less than 75 units have all these documents. All right. Now, calculating net operating income. This is the meat and potatoes in multifamily commercial investing. You got to understand how to calculate net operating income. And it's a simple formula. The effective gross income minus operating expenses, right? Now, some of y'all understand what net operating income is without realizing. Remember when you got your first job and you did that math in your head? I did. I was like, okay, look, I'm working at Raging Waters Water Park. I make $6 an hour. I worked 40 hours. Okay, that's $240. So when I get my check, I should see $240 on the check. And it was not $240, was it? The $240 was my effective gross income. Taxes were the operating expenses. So my net operating income, my net income was a lot lower than that. Same with multifamily, right? So start with gross potential rent. So what the property would earn if it was fully occupied. Subtract estimated vacancy and collection loss, so 5 to 10%. And then subtract the following expenses: property taxes, insurance, utilities if paid by the owner, repairs and maintenance, property management fees, administrative costs, and reserves, usually $250 to $300 per unit if you can. But if not, you do what you can where you are with what you have. The result is your NOI, okay? So you take gross potential rent, and then you minus vacancy, collection loss, property taxes, insurance, utilities, repairs and maintenance, property management fees, admin costs, and then you want some for reserves. Landon says, I wouldn't buy multifamily right now. Well, multifamily is not the same everywhere. And what really impacts multifamily in my decision is the state that it's in. And I look at all over the country. So I would not buy multifamily in California, Oregon, Washington, New York, New Jersey. Definitely not. You would almost have to give me free multifamily to own in those states, because it gets far more expensive to what shows up on your financials because they're so tenant friendly. All right. Landon also says, I had one. Turnover rate is too much. So if the turnover rate is too much, why? You got to figure out why. So if you have high turnover, that's telling you a story, and you just got to figure out, okay, well, why is that and how do you fix that? Vacancy loss is something that's really, really easy to fix. One of the things that I bring from the multifamily commercial industry is the 4 Ps. If you address the 4 Ps, you'll address vacancy loss: person, product, promotion, price. And this goes for any vacant unit you guys have. Person, product, promotion, price. Person, is the person responsible for getting it leased doing what they're supposed to be doing? Are they posting multiple times a day? Are they setting up appointments? Are they facilitating the process like they're supposed to be? Product, is a product show ready? Is a product in good condition? Promotion, are you promoting it to the right places? On the West Coast, Craigslist is the #1 referral site for multifamily commercials. So much so that in that industry, you are required to post 3 to 5 times a day on Craigslist, or you could get written up. Okay. Now, it may not be that way on the East Coast, but it's still effective, and same with other areas in, throughout the country. The last one is price. It doesn't matter which order you address these in, as long as price is last. Person, product, promotion, price. If you fix the first 3, more often than not, you don't have to fix the last one. So if you are having a struggling with vacancy, that is more a management issue than the building and the process itself. All right. See how I threw that quick lesson in there? All right. You guys in our real estate family, there is a lesson. You guys already know it. It's called Landlord Launchpad. Everything I'm talking about with respect to the operations and the management of multifamily commercial, then is in that. And I'll make sure you guys get it. Single family people will stay for years. Okay. I got single family all over the country. Okay. It's not the asset class. It's how it's managed. All right. Now, determining the cap rate. The cap rate is the relationship between the net operating income of a building and its market value. So I use the example. Let me see. Don't agree. All right, Landon. you keep them great. All right, good for you, man. You just said you had some issues there, but okay, that's fine. I think you were talking about apartments or something when you said that. So the value equals net operating income divided by the cap rate. The value of the property equals the net operating income divided by the cap rate. Another way to say that is net operating income divided by cap rate equals value. If I have a net operating income, let's say I got a building that makes $3,000 a month times 12 months is $36,000. It's a small building, so I calculate 20% for expenses. That puts me at $28,800 for net operating income. Divided by a 6.5% cap rate, $28,800 divided by 0.065 is $443,077. That's the formula. All right. Every mayor in Florida wants several multifamilies in their cities. They'll find you the money. And yeah, you would think so, but it's not always that simple. The mayors that want multifamily need to do something about the permitting process, and they need to be petitioning the governor about the insurance premiums. That's basically what's keeping some investors from bringing multifamily to the area. Right. And believe me, when I say that, I've sat in meetings with mayors, city council, and all of the stakeholders, people from the land bank, heads of banks, and I've had these conversations over and over and over. Everybody wants it, but nobody wants to make it advantageous or streamline the process. You streamline the permitting process, and then you'll probably start getting more multifamily. The only way out of the housing crisis is to build our way out of it. But they make it so, and it's not worth it. All right. All right. So determining the value using the cap rate. Cap rates vary by market, asset class, and condition. In hot markets, you may see a cap rate of 4.5%, 4 to 5%. In more rural or distressed areas, it might be 7 to 9%. For example, if the net operating income is $100,000 and the market cap is 6%, the value equals 100,000 divided by 0.06. The value is 1.67 million. Let's talk about higher cap rate versus lower cap rate. All right. Now, I always look at cash flow. I don't get caught up in cap rate. The cap rates can be manipulated. Cash flow can't. I look at both. Now, if the cap rate is influenced by the net operating income, the net operating income can be influenced by deferred maintenance. So those are things that haven't been done that I'm going to have to do that is going to impact my net operating income, which is going to impact my value. All right. So let's talk about, now this is where material gets you dry, right? This is where you guys really need the lesson for this to be able to really wrap your head around this. Higher cap rate versus lower cap rate. Whether a higher cap rate or a lower cap rate is better depends on your investment goals in the context of the market. Let me say that again. Whether a higher or lower cap rate is better depends on your investment goals and the context of the market. Real quick, for those folks on TikTok, I will send you this lesson if you text the word guide to that phone number above my head. I'll make sure you get it today. All right. A lower cap rate usually means you're buying in a more competitive, stable, or desirable market, but you're paying more per dollar of income. A higher cap rate typically reflects higher risk, such as in rural areas or with distressed properties, but it also means you're getting more income for a lower purchase price. Okay, it's not always which one is better. Now, keep in mind, the more competitive markets with the lower cap rates, these are typically where you're going to find most of your institutional investors. These guys coming in and dropping $200 and $300 million for, a multifamily asset, right? Now, I'm not competing with them. They're too well capitalized, and my little 20 and 50 unit choices that I'm making, it's not worth their time. A lot of them have shareholders, and there's a completely different ball game. That's the ball game that I come from in my corporate life. Okay, we don't even want to compete with them. So in short, a lower cap rate equals higher price, lower risk, often lower return. Higher cap rate equals lower price, higher risk, potentially higher return. That's what you need to know about them. But look at it this way. Just look at the cash flow. If the cash flow numbers are satisfactory to you, who cares what the cap rate is? All right. But it's, it makes you sound smarter when you start talking about cap rates at parties and stuff like that. Right? I go to some of these events and I just hear people talking in the lobby. Some vice president of one of these companies.
Unknown caller.
Oh, all right. Some VP of some of these companies, and anyway, let me not. All right. Evaluate financing terms. Now we're talking about debt service. Okay. Now, assess what it takes to finance the deal. Most buyers use a commercial loan to cover 70 to 80% of the purchase. That makes it a lot easier if you have, 20% to put down. Keep in mind, I'm a value add investor. Just because commercial lenders require that down payment doesn't mean it has to come from me. I can borrow that, or I can raise that, or I can structure that deal to pay out of my exit strategy. There's a lot of ways to come up with that. Okay. But that is the difference between approaching real estate investing as a consumer versus approaching it as an investor. Now, if I get 10 more shares on TikTok, then I have another guide that's going to help you with operating your, your properties, managing your properties. All right. Now, key considerations, loan to value. All right. Now let's take it back to the basics. Loan to value is the loan relative to the value of the property. If you're buying a $100,000 property and the loan to value is 80%, that means they'll finance 80%, the loan relative to the value. Interest rates, current rates for commercial loans vary right now between 6 and 8%, but that could change. Amortization, most loans are amortized 25 to 30 years. So when they calculate what your monthly payment is going to be, there's an amortization schedule, shows you what the payment is over the course of, and how many payments there are over the course of that term. All right. When we say debt service, that's your monthly mortgage payment. All right. Now, DSCR equals NOI divided by the annual debt payments. Let me simplify that, because that's where people get in trouble. A DSCR loan, folks, is a mortgage where they don't qualify based on your personal income. They qualify you based on the income that the property generates. DSCR stands for debt service coverage ratio. For example, if your DSCR requirement is 1.25, because it's typically in decimal form, what that represents is you got to convert it to a percentage. That means if your monthly obligation is $1,000 a month and your DSCR requirement is 1.25, they're saying your rental income has to be at or above 125% of that $1,000 a month, which is $1,250. A simpler way to figure that out is you take your monthly obligation on that mortgage and multiply it times 1.25. 1,000 times 1.25 is $1,250. Okay. Anything lower than that is higher risk for the lender. Okay. All right. I'm not going to spend a whole lot of time on financing terms. If you guys want this, you guys that are getting this lesson, you'll see it in there. Financing terms are if you're coming straight in, you've got the capital and there's no issues. What I try to do is, all right, we're at 50 shares, so I'm gonna give y'all a little something extra. So what I try to do as a value add investor, if I can find properties before they hit the market, before they come up for sale, and I can have a conversation with the owner, I can structure that deal to pay for the property out of my exit strategy by accomplishing 4 things. The first thing is the 4 data points. I got to be able to see if it's even worth doing in the first place. The second thing is taking control of the property, and this is the magic pill: getting my name on the deed before I have to pay for it. So they deed the property over to me, but I'm still obligated to pay for it. Well, how do I get them to trust me? How do they know once they deed it over to me, I won't leave the country or whatever, right? Now we get into managing debt. Okay. This is the seller financing component. And you can structure the seller financing component where you make monthly payments, or you can make it to where there's no payments due for 4 or 5 months, and then you pay the entire balance out of your exit strategy. So folks that are looking to do seller financing, there's 2 documents that it takes to accomplish seller financing. Promissory note is evidence of the debt. Security instrument takes that note and, once recorded, attaches it to the property in the form of a lien. So when I exit out of the property, whether it's a sale or a refinance, that lien gets paid automatically. That seller gets a check. Because I ran the 4 data points, I know what my profit margin is, so I know what additional compensation I can give them for allowing me to do it creatively. All of this stuff works together. That's component number 2 in structuring the deal creatively. Component number 3, in order for me to be able to pay them back, I got to be able to make the property worth more than I owe them. All right. So I've got to increase the value. I know that I can increase the value because I ran the 4 data points in the beginning. And then the last component, number 4, is exit, either refinance to pay them off or sell the property to pay them off, and I keep the difference. All right. No one will do that unless they are in distress. All right. Are you sure about that? I just did one. So they weren't in distress. They had to leave the country. So I did a seller finance deal for $95,000. I gave them $1,000, good faith, right? They deeded the property over to me. I tried to pay them every month, but they were too hard to get a hold of once they left the country. So they finally got back to me after a few weeks and was like, hey, you know what? Just pay it off in 6 months. I was like, all right, cool. I ran the 4 data points. 5 months came, called my lender, looked to do a cash out refinance. They had the property appraised. It appraised for $180,000. I did a cash out refinance for $121,000, I think. Paid them their $95,000, kept the difference. I didn't even really want the property. I bought that property as a package deal for some other that were performing. I didn't even know it would appraise that much. I thought it was going to be a dud. And then a year later, I sold the property for $199,000. All right. So how much money did I make off that? I put $1,000 into it and then got some money out of the refinance and then sold the property, for $199,000. So yeah, it is possible. It's not just people that are in distress, but that's going to be the biggest group. So there is some truth to that. All right. If someone's not in distress and they don't plan on making a move, then why would they allow you to do it creatively? Well, they'll allow me to do it creatively because I'm not just giving them what the property's worth. I'm giving them the portion of the value add. So if I'm giving them a portion of the value add, that means based on their financials, we're in agreement what's the property's worth. I'm going to give them that, and then I'm going to give them more than that. Right? So they're selling it to me for more than they would have sold it on the open market. Yeah. All right. Cash flow and return. All right. Let me see. Can you do a DSCR for a purchase when buying on a lease to own? No. But what you would do is if you're doing it on a lease to own, and I'm assuming that you're referring to a lease option, you could do the DSCR loan when you exercise your option to purchase it. And if you negotiated the lease option correctly, then you can utilize some of the equity that's been built up or negotiated in to satisfy the equity position for the DSCR loan. DSCR loans, they're not going to finance 100%. So you've either got to have 20% equity or come in with a 20% down payment if you're going to purchase it and not refinance it. Seller keeps deed until option is exercised. Yes, that is correct. Till option is exercised, seller keeps the deed. I got a lesson on lease options. I did a whole workshop on lease options. All right. I think, let me see. I've got value add strategy and, I think I'm gonna hold it right there. I think I'm gonna hold it right there, because I'm. Thanks for sharing your knowledge. Amen. So whoever just texted me with the last four of 9103, I appreciate that. I'm gonna give you guys a little something extra. Okay. Sorry about that. It was an incoming call. All right. 4 Data Points Academy. We have no end date, so we don't put a timer on your success. I don't care if it takes you 3 months or 3 years or 5 years. We're in it for the long haul. Why? Because I created this organization to be able to create real estate investors. That's not something you can do in 6 months. You can get all the real estate training you need, but maybe an opportunity doesn't come for 8 or 9 months. Are you gonna try to remember everything you learned and open up these PDF lessons and try to do it? Well, shoot, if that was going to be effective, you could have just bought the PDF lessons in the beginning. That's not how it works. There needs to be some hand holding. Once you get into multifamily commercial, most of my students that are in multifamily commercial now started in residential, and I've coached them up. All right. We probably talk 7 or 8 times a week. These folks are active, right? But when they came in, they didn't know anything. They were working full-time jobs and had to survive. So a lot of these things I was teaching them how to first manage risk. I always teach that first. How do you protect your financial future? Don't get into something you can't get out of. Don't get caught up in all the hype. There's no get rich quick, right? There's a get rich, but ain't no get rich quick, all right? So we have no end date. We're the only program that doesn't have an end date. Why? Because it costs too much to allocate time and resources to people long term. All right. So if it's not profitable for these companies to do, why would they do it? They're businesses. They exist to generate revenue, not to create investors, not in my opinion. We have a service where we find your first deal for you. We support you in contractors, finance, everything, right? You go to our website, all that information is on there. Our trainings are all live. Now, do we have some automated stuff that we're implementing, right? I've got to upload. I have a course that I don't charge for. This course is only for my students that are already in the program as a learning tool. I don't do courses. All the trainings are in the evenings. We understand people got to work. People got to survive. Our trainings are 5 p.m. California time, 8 p.m. in the evening, or East Coast time. We got to be flexible, right? And we got unlimited support. All right. So I have an agreement. I will stay in the fight with you for as long as you stay in the fight. 90% of the classes I teach directly. I do have other trainers on standby, but most of my students have never even seen them because it's too hard for me to let go. All right. All right. Now, that being said, I'm going to go ahead. I'm going to stay on TikTok and I'm going to do some more questions. I'll keep Clubhouse open. I'll do some more questions. You folks that are on Instagram, enjoy the rest of your day. Same with you folks on YouTube and Facebook. Enjoy the rest of your day. 4datapoints.com. You guys know how to find me. You guys have all my social media for the most part. And